Good afternoon, everyone out there. We're very happy to be able to introduce you again to another Trading Crude Oil webinar. This is a second and last one in the series, and we're really optimistic that you'll be able to take a lot of learning lessons from today's session. We have got some great speakers lined up, some usual faces from the last session, some new ones, but really working with BVG and with PwC. So thank you again for the participants who are going to be sharing their expert knowledge with you. You can see we've got quite a bit of material to cover through today. I'm hoping you're going to be listening to a lot of chatting from us, but ultimately we'd like to see you using the instruments in the weeks and months to come. Remembering there are two types of participants in the market, hedgers and speculators, and it's important that when you start to use the instruments you understand where you're coming from. Are you using them to hedge or to speculate? And then just understanding the different risk profiles. But the purpose of today's webinar is certainly to go into a lot more detail and really don't want to waste too much time, but kick off and today handing over to Johan Marais from BVG to take over and handle through a few of the slides. We'll then followed by PwC, and after that I'll just wrap up. So we've got an exciting hour for you. As usual, we'll be putting up the webinar onto the website for later viewing, but over to you. Thanks, Johan.
There we go. Good afternoon, ladies and gentlemen. Thank you very much for the opportunity to speaking to you today. I'm going to speak specifically on the instruments that we have available, as Chris has alluded to, how they work, and very sort of briefly looking at the payoff profiles, etc. And then I'm going to focus on this issue of hedging and some of the issues that we need to look at, the pitfalls, and also a hedging strategy, what that should look like. So let's hop into it immediately. Firstly, the trading instruments, as you know, is confined reasonably simple to futures and options. I'll get to each of them in the next slides. We're going to just note the following things. Because they trade on exchange, they have standard specifications. So this means that you always know what the contracts look like, and they are always the same. Very importantly, these things are financially settled. So you're never going to have crude oil barrels rocking up at your front door or somebody looking for barrels. The settlement is financially on the net difference between the instrument and the market. We are going to talk about where they come from. They're backed by the 4 big banks in South Africa who act as market makers and who provide the liquidity and obviously the two-way prices. And then because these things are on exchange, you trade them through a broker who act as your intermediary. Now, as Chris has mentioned, you can use them for either speculating or trading, as we would like to call it, or for hedging. And the two have, you can say, very different aims. And I'm going to talk very, very much more on the hedging just now. An investor obviously looking to get price participation. So he wants to get benefit from his view. A hedger, on the other hand, in a way wants to get rid of exposure to a price. And he wants to limit his risk to that. Okay, now let's look at futures first. A future obligates the holder to trade underlying, in this instance crude oil, at a fixed price and at a fixed date in the future. Now this gives you certainty of price because you lock your price in. However, it also doesn't give you any flexibility because you're locked into that price. Now you don't pay any upfront fees for this, so that is quite a tremendous benefit. There's no money that you need to fork up in front for this. However, if the market moves against you, you will have to pay in. And that is the one thing that you need to remember when you trade. Now, to counter against this potential risk in the future, exchanges don't normally give you credit lines. They insist that you put up a margin for this, an initial margin to cover against the initial movement. And then if the market continues to move against you, you will have to put up additional variation margin. If the market goes in your favor, obviously the profits will be paid into your account. Now these requirements are set by the exchange, and it is typically a function of the volatility of the market and also the liquidity that is in there. Now let's quickly just look at how a future will work, and we will look at it from the point of a long future, meaning somebody who bought a future. So this is somebody who thinks that the market is going to go up and who wants to benefit from that from a trading point of view. From a hedging point of view, this is somebody who has exposure to the underlying, who has to buy the underlying, and so he will get hurt if the prices go up. So he hedges against this using long futures. Now the graph that we have here, right there, shows both pictures. The one is from the trader point of view. Now what happens? He enters into the trade. Going forward, if the market is below the future, he is in a loss position and he will have to pay in that loss. Conversely, if the market goes above the futures price, he's in a profit situation and that money gets paid into his account. So there is the no participation, if you like. Now let's look at the hedging situation. Now bearing in mind that a hedger has an underlying position that he combines then with the hedge. Now our hedger here, the long underlying, and he buys the future. Now what happens? If the market is below the futures price, he has to pay in on the future. Okay, so that's the downside, if you like. However, very important to note that he has the benefit of the cheaper underlying. And the two should offset each other, and thus he is locked in at the futures price. Conversely, if the market is above the futures price, he now pays more for his underlying. But he bought a future, and so he gets the benefit from the future. The two again offset each other, and he is locked in at that line over there. So this is from a futures point of view. Now, you do get people that obviously want the protection or the participation, but they don't like the fact that they're stuck with that price. So what can they do? Well, it's a very simple solution, and that is called options. Now, you know the definition. It gives the holder the right, but not the obligation to buy or sell the underlying. If he buys the underlying, he will buy a call. And if the option is to sell the underlying, it is a put option at a future date called the expiry date, and at a fixed price in the future called the strike price. Now, what options do? They give you the certainty of price similarly to the futures. However, they do give you participation should the market move against you from a trading point of view. For this, it costs money. You have to pay an upfront premium. And once that is paid, that is out of your pocket. However, very important to note, once that premium is paid, you will not have to pay in anything again from a long option point of view, regardless of what the market does. And that is the big benefit of a long option position. So no margin issues, no variation margin, no calls from your broker. You have certainty on that. The option premium is linked to, amongst others, the volatility of the market, the level of the strike price, and also the duration. And I mean, this is exactly similar to insurance, where if you live in a high crime environment, volatility is high, you pay more for your insurance. If you insure for a long period, your total premium is higher. And obviously, if you insure a lot of stuff, again, your premium is higher. So it's exactly the same principle for options. Next thing with options, you can buy them, you can also sell them. And that's quite important. We'll get to that shortly. Long options, having bought options, as we said, carries no risk to the market once the premium is paid. Short options, on the other hand, whilst they generate premium, you take on full exposure to the underlying market. Now, we'll get to that just now. Let's just look at the long options or the buying options example. And we're going to look at this from the point of a consumer, or again, a trader who thinks the market is going to go up. So instead of the futures route, you go and he buys a call option. What happens, and the graph there, which is your typical payoff profile, shows what happens. If the market stays below the strike price, which is denoted by that S, now bear in mind he had to pay the premium to get into this option. Now if it is below the strike price, nothing happens. He doesn't have to pay in anything. If the market goes higher than the strike price, so according to his view, the options start to generate profit and he gets pay into his account. And it starts to make money. Likewise, let's look at the hedging position. Now again, as in the previous case, the hedging, we need to look at a combined position of the underlying plus a long option which is used as a hedge. Now, how does that work? Well, whoopsie, I apologize. There we go. If the underlying moves up, you obviously pay the increased price, okay? Up to the point of the strike price. But he gets the benefit of that cheaper price. There's no additional payments that he has to make. So he gets that full benefit. Once it reaches the strike and the underlying goes higher, obviously he has to pay the higher underlying price. But as we said here, the call options start to now pay into his account. And the net effect of the two is that they cancel each other. And he is then protected at that strike level plus the premium, because we need to remember that the premium is a reality. You have to pay the premium. The put example is exactly the same. The only difference is we're now talking of either somebody who's bearish on the market, who thinks the market's going to go down, or a producer who has exposure to prices falling. The other very important thing with options is you can choose, obviously, your quantity, but you can also choose the strike and the expiry date. And so you can fit it to your profile that you have. Okay, now we're going to the next slide. And that is selling options. Now, we have said that just as you bought an option, you can sell it. And as you have to pay a premium to buy an option, well, when you sell an option, you get that premium upfront into your account. So that sounds wonderful. However, you now have full exposure to the underlying market. An option all by itself is called a naked option, a naked position. Now, our option seller here will retain all of his premium as long as the underlying market does not go through his strike. If it goes through his strike against him, well, firstly, it will erode his premium, so that's still all right. But the moment his premium is eroded, he will then move into a real loss situation. So you most certainly take on risk when you sell options. Okay, who would do this? Well, somebody who wants the premium. And somebody specifically who may have the view that the market is not going to go through the strike against him, and he wants to monetize that. So he sells an option, he gets the premium, and let's hope it pans out as he thought, and he keeps his premium. Okay, so that's the one seller. Also people that use the option premium to subsidize another part of the structure. Professional option traders who run big option books, and they obviously buy and sell options to balance their books. And then hedgers. Now, you may be surprised at this, because we just said when you sell an option, you take on risk. And a hedger most certainly do not want to take on risk, quite the opposite. Well, we'll get to that. As we said, a short naked option is not a hedge. So we'll get to that just now. We'll just note, for interest's sake, that your potential loss on a sold put is limited to the underlying going to zero. Whereas on a sold call, theoretically, it's infinite. Okay. Now, how do hedgers use, why would they sell options? And we're going to look at this specifically from a hedging point of view. Now, remember our consumer of a few slides ago, he wants to get protection against prices rising. So, I pressed the wrong button again. He buys his call over there, set at the strike, to get protection above the strike. We dealt with that. Now, you can sell an option lower, and then obviously you will get premium then into his account. He paid premium for the bought call, he gets premium for the sold put. Okay, now why would he do this? He may have the view that the market may go through the strike, so that's why he wants the call, but it may not do so, and he wants to get the benefit of the lower underlying price. But he may also think that the market is not going to go lower than this put. So he sort of doesn't care if it goes below the put, and that's why he would do this. Now, let's look, and now we got the right button, at what happens here. He is protected above the call. His realized price is fixed at the call or the cap level, if you like. He has benefit to the underlying if it were to fall below the cap, which is wonderful. And for that, he is now locked in at the floor price. So if the price, the underlying goes lower than the floor, he's locked in at the floor. But he's happy with that. And for this, no premium. It can be done at a zero cost if the strikes are chosen correctly. So this is fantastic, because this gives you the benefit of options, but at no cost, no upfront cost. And this just shows how powerful options can be. You can do wonderful things with options by combining them to suit your specific desired profile. I'm not going to deal with that. You do get fancy things called straddles and strangles and all sorts of things. Okay, now we've dealt with the instruments. Let's now move into applying them for hedging. And this is quite an important topic, and it can be a very, very contentious issue for a number of reasons. Firstly, misconceptions exist about what hedging seeks to achieve. Hedging is not about making more money. That is very, very crucial. You hear a lot about hedging losses, and people tend to forget that if hedging is done properly, the hedging losses will be offset by gains in the underlying. Another thing is the cost of hedging is misunderstood, and there will be costs. Futures no upfront cost, but there may be the potential cost of having to pay in. Options require premium, and they can be expensive depending on where you choose them. And then importantly, and Johan is going to talk about that, the whole issue about how you report hedges is a very, very crucial issue. And people are unsure about that. And that is why we're going to talk about that as well. So what is the challenge? The ultimate aim of hedging? Well, it is to remove or limit unacceptable risks, those risks that you don't want in your business. And then to balance the costs of the hedging against the benefits. And if done correctly, the benefits will greatly exceed the costs. The overall objectives, fairly simple. Control costs. Limit your losses. By doing this, you're going to secure your margins. Who should hedge? Simply, people who have risk to adverse price movements and who get hurt by these. You also get opportunistic hedging. Now, we shouldn't confuse this with speculating. Opportunistic hedging refers to somebody who, as a rule, may not hedge, but he finds himself in a market that is very advantageous to him. So he could, for instance, lock in price levels that are way below his budget. And by doing so, he can guarantee that. So that is what we call opportunistic hedging. Strategic hedging, not to be confused with our heading of the slide here, this refers to slightly less concern with your bottom line on a short-term basis, but people who hedge as part of their overall company strategy. And then forced hedging also exists. It's not as bad as it sounds. Very often banks, in order to provide financing, will insist that you hedge your underlying risks to make sure that you will be able to repay your interest and your repayment obligations. Okay, what are the issues that you need to consider? And there's a number of them, and these are just a few. First one, basis risk. Now, basis refers normally to the difference between a futures and a spot market. We're going to take the liberty of taking basis to mean any difference between your hedging market and your underlying market. Now, clearly a large basis will exist if the two markets are different, if they're not related in any way. Let's say you use wither derivatives to hedge a copper production. That will just be completely nonsensical and you add tremendous risk. If, however, the two markets are either the same or very, very closely correlated, then a hedge can be very effective. Important to note that this correlation, you need to make sure that it is over a long period of time. Okay, then we need to distinguish again between hedging and speculation. Speculation is entering the market on an opportunistic basis, hoping to make more money. Hedging is to make sure you don't make less money. And there's a crucial difference there. Then the next thing is making things too complicated. We believe that the best hedge is the simplest hedge that will achieve your desired objectives. No more complicated than that. And we think that's very important. And then lastly, accounting backlash. You need to make sure how you want to account for this, and then make sure that this is in place before you enter into any hedging. Okay, potential pitfalls in all these considerations. We've mentioned the basis, that is a very important one. The next one is you need to match your hedge with your underlying. Now, under hedging is when you hedge just a teeny weeny little portion of your underlying exposure. That may make sense if you want to test the water, if it is something new to you and you want to see how it works. Generally speaking, you leave open too much risk and you may as well not do it. So you need to make sure that you hedge that amount that is crucial to your company. Probably more important than this is the danger of over-hedging. And that is when you hedge more than your underlying position. Now, when you do this, you actually add risk. And let's think why. Especially in a futures environment, typically we just mentioned that when you have a hedging loss, that should be offset by your gain in the underlying market. Now, if you hedge more than your underlying position, where are you going to get the money from to pay into the hedge? And that is why we say you add risk. So very important that you determine exactly what your guaranteed consumption or exposure profile is before you enter into any hedges. And then not understanding the hedging cost. Oh, and by the way, the graph we have here just shows sort of graphically what I just spoke about. Your neutral hedging position is that one where you minimize the risk that you have exposure to. Too little, you have risk. Too high, you have risk as well. You want to get to this point over here. Okay, not understanding the hedging costs. Again, the fact that you may have to pay in if you went the futures route, and you need to understand why this pay in, so that there's no backlash from that. And we hear a lot about hedging losses, and it is in the newspapers, etc. And it is as if people lose their objection of where it is. When you have a proper hedge, it's offset by the underlying position. Now, options obviously will prevent this. As we said, there's no pay into options. However, it does cost money. So that needs to be understood and approved for. Now, whatever way you go, the cost that there will be, you need to be prepared for that and be able to fund it. Now, generally speaking, once you've done all of this, you have sort of the outlines of a proper hedging or risk management policy. And this is the only way in which we believe you should go into a hedging. Now, let's look at some of the components of such a policy. And we believe it's crucial that you have this. Firstly, you need to set your objectives. You need to know why you want to do this. And the reasons could be to limit your price exposure, lock in the margins. We referred to that before. Equally important is you need to identify those risks that are important. Those risks that if you leave them open, if you leave them unhedged, they can harm the company. And typically these are the risks that the company does not get rewarded for taking. So you want to focus on your business that affect your bottom line and remove the other risks. And obviously you need to analyze the cost to make sure that you understand that and that you can balance the costs against the benefits. Now, once you've done this, you need to set the framework in which you're going to hedge. The strategies that you're going to use. Are you going to go the sort of fixed price, no upfront route, or are you happy to pay the premiums for the options? You have to have mandates in place. Who can actually do the hedging? How do you get approval? Is it a blanket approval, or do you go to the board every time you want to hedge? Trading on exchange, credit approval is not really relevant here, but you need to make sure you have the appropriate lines and relationships in place. Fourth, you've now done this, now you want to pull the trigger. You need to make sure you do this according to pre-planned objectives. Firstly, the frequency. Do you do this once off, once per year? Do you do it regularly? Do you do it based on certain signals that you look for? And equally important, the hedging ratio. How much of the underlying are you going to hedge? Pricing execution policy on an exchange, again, slightly less of an issue. However, your choice of a broker, you may go through numerous brokers trying to get the best price, or you can have a trusted relationship where you know you're going to get good service. And then, once you've done the hedges, you can't forget about them. Mark to market and reporting. You need to be able, on an ongoing basis, for the lifetime of these hedges, mark to market them, i.e. Compare them against the market and report on that upwards in the company. Now, your broker and the exchange will assist with this, but it is ideal if you can do it yourself in the company as well. Your frequency, at least once a month, we would say at the end of the month. And again, as we said, you should do this even if the hedges was deemed to be held to maturity. Let's just look to conclude our discussion on the hedging. I've been going on about how good hedging is, but I did mention the pitfalls and the risks. Let's look at two case studies. I'm going to mention the one very, very briefly because it's quite complex, but it's quite a famous one, Gesellschaft, a German company. In December 93, they had short forward oil petroleum positions going out for 10 years. They hedged this with short-term long futures. Okay, now, economically, they were hedged because the two should offset each other because it's basically the same thing. The issue was that futures, they did what is called stack hedging, where they sort of went short-term and then they rolled it continuously as time went forward. Now, the general expectation during that time was that the oil market would be in backwardation. What this means is that your longer forward prices are lower than the near month prices. And when you roll this in a backwardation environment, you will actually get some gains. However, against the expectation, the futures market, the oil market went into contango, which means the opposite. So now they had to roll their futures position at a real cost. And because their positions were quite large, it was quite a tremendous loss. Coupled with this, they had to report the future losses with their income statement, which made it even more in the public domain. So one can argue this was a hedge that was too complicated, and also there was this funding risk, which became a real risk, and also a view. They had a view on the curve, which went against them. We have included here a website that you can go look at for all the sort of famous case studies. Okay, now this is a hedge that went wrong. This is hopefully the minority. A hedge that went spectacularly right, and Sasol won't mind me mentioning this because this is in the public domain. Sasol has an effective long crude oil position, which they hedge from time to time if they deem it fit, and they typically hedge a year out. Now, one of these times was in 2008. Now, you may remember that in 2008, the oil market hit a high of in the 140s dollar per barrel. Sasol happened to conclude this hedge 2 days before the market reached its high. And they did it with a producer collar. Now, this just shows the power of a collar, for instance, because what they did is they sold a put, and the floor was set at $90. And for this, they were locked in on the upper side at 228. Now, nobody, I think, at that time, even at those heady levels of oil, thought that oil was going to go higher than 220 in a year. What happened, as we know, literally in the next few months, the market crashed. It went way down below 90, and Sasol benefited greatly from this hedge where the floor was set at 90. So I hope that gave you a sort of a general idea on hedging, the issues that one have to consider, how it works, and then some case studies. I'm now going to hand over to the next speaker. Thank you very much.